All right, here we go. It's Tuesday morning, half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: Chinese equities in focus as they inch closer to a bull market. Asian stocks rising as investors welcome that strong start to the earnings season.
Now, this hour, PMI numbers are out, expected to edge lower while staying in expansion territory, reflecting fairly fragile economic rebound.
And Japan's top currency official pledging action to counter excessive yen moves as traders warn the government will need sustained intervention. Yeah, we continue to see this rally, of course, and Japan's really leading the charge here today, coming back from that holiday. And really, you got to wonder what these FX traders are thinking about after missing out on yesterday's fanfare when it came to dollar-yen, right? So that steep 562 pips in terms of the high to the low range that we saw from 160 all the way to 156. Now, we haven't seen such a drop really for a very long time. You continue to see a little bit of weakness here, but we're definitely around that 156 level here. You got to wonder what comes next, right? You know, of course, we still haven't got official confirmation that the Ministry of Finance had intervened. They said, according to Kana-san, you'll know by the end of next month when they release that sort of data. But certainly, there's speculation out there. Is just the first round? Or would you like to see a series of interventions moving forward here? You have the likes of Bank of America saying, look, we will see continued weakness in yen we need continued FX intervention, I should say, in order to keep dollar-yen below that 155 handle here right now. But that's certainly helping Japanese stocks here this morning. Take a look at the Nikkei coming back from that holiday. We're up some 1%. We're watching Samsung shares very closely here, just given those earnings that we got. The chip business, profitable again. That certainly is helping lift the stock. And some of these chip makers here today, Taipei is pretty much flat opening up. And we're watching, of course, where Brent goes. We saw the biggest drop in about 2 weeks or so. There's talks of a possible ceasefire in the Middle East. So that's really reducing that risk premium here this morning. And there you go. You take a look at Samsung Electronics. We're up about 1.5%. SK Hynix and also TSMC opening up now, seeing some modest gains on some of these chip makers here this morning. The setup for China, of course, is this, right? So yesterday we thought we were on track to hit that bull market when it comes to MSCI China, whether it's the Hang Seng as well. We didn't quite get there. So towards the end of the session, we did see maybe a bit of profit taking being taken place, Dave. So there is still caution, I guess, in the wind of whether this rally after 20% can actually sustain itself here. So we're still on bull market watch. Looks like we're seeing some decent gains in futures here this morning. Watching ultra long bonds though, right? So take a look at where yields are. We're slightly lower today, but we've seen that 10-year up about 13 basis points, that yield in the past few sessions or so. You're hearing, according to our sources, that the Beijing government is telling some of these provinces to stop buying these long bonds, just given the 6-month rally we've seen. We certainly see that in the 30-year as well. 724.45 for dollar China, Dave.
Yeah, 4 days of losses on longer dated CGBs, of course. And so to add to what Yvonne just mentioned there, right, bonds tend to do well when the economy doesn't. And if the economy does rebound, when it does rebound, what happens to those banks sitting on those fairly expensive bonds, which, by the way, have gone in one direction. So we're watching CGBs very closely today. As Yvonne is pointing out, we're still in bull market watch. We were closer in on that as well. Property stocks, I forget we were up, 10 or 50% yesterday. I mean, doesn't matter. It was quite ridiculous, really. And we have, of course, these ETFs listing here in Hong Kong today. So we'll be live, of course, out of the Hong Kong Stock Exchange. And Annabelle, of course, is our person on the ground there. Lots of good conversations coming up. And, of course, not to mention as well, earnings. HSBC comes out today. We're coming out of Yum China. And, of course, also the Chinese currency. Biggest move in yuan in about a month or so. Might be down to the fact that we had this big move down in dollar-yen.
Yes, and can we see further sort of movement here today? Of course, Japan coming back from that holiday, of course. You take a look at how yen is doing right now, though. We seem to have stabilized a little bit. We're still seeing a little bit of weakness, but, when it comes to some of these yen pairs, you're still catching a slight bid when it comes to euro-yen, Aussie-yen here this morning. But yeah, that you did see a little bit of a drop with the renminbi against the yen, but certainly there's so much suspicion of what really happened 24 hours ago to have that sort of 6-7 handle drop as well. Let's bring in our Bloomberg Intelligence Chief Asia FX and Rate Strategist, Stephen Chu. Stephen, what happened, do you think?
So, 5 yen move in a day is very likely to be intervention. If you listen to Kanda San, like the currency person from Ministry of Finance, they said they're gonna announce something like by the end of next month. So very likely they have intervened yesterday. It's Japan holiday, so it's the best timing to intervene. Liquidity very thin, like a little bit of bullet can actually magnify and push down the dollar yen. So that's what's happened. But again, like what has changed? I mean, like just look at the dollar. Look at the yield differential. It's still in favor of stronger dollar. Now, 2 years ago, they did intervene twice. And what we see, the first intervention actually didn't work out because the Fed was still hawkish, markets were still pushing for a stronger dollar. And then the second intervention worked a little bit because markets tried to pivot and bet for a Fed cut. So that worked, but that's because of the Fed and the dollar. So now, obviously, FOMC matters a lot, and we don't think the Fed is going to signal something dovish just yet, and they're not going to cut certainly in this quarter. Yeah. So that's why the dollar will stay supportive, and hence dollar yen will be supportive here.
Is that why dollar China fell a lot as well yesterday?
A little bit. I mean, like to some extent, like you talk about like the long bonds actually selling off, that might help a little bit because data may come in a little bit better off the back of like fiscal support, monetary support. But yes, it's really the yen that's pushing Asian currencies.
There's a bit of chatter about China maybe looking at some sort of mini devaluation. I mean, do you think that's plausible at this point?
I'm not a fan of that. Now, if you look at dollar China, obviously a stronger dollar will have to push China to let dollar China to drift higher, whether it's a fix, whether it's a spot, just because the broad dollar is so strong. But if you look at it from a basket perspective, the yuan is actually so strong. We're talking about 98 from a CNX perspective. Using the fixing, it's above 100. The basket is just so strong. China really, like, they don't have to devalue. They have to just keep a pace, like the drop in the yuan to be at a pace that's acceptable, but not like a one-off devaluation. They don't have to do that at all.
You mentioned CGB yields. Let me just get your thoughts on this. We have two stories today. China Central Bank wants to halt the bond buying spree, not join it. Some concern around bond market bubbles in China. Is there a bubble there, you think, in CGBs?
There are certainly risks. Now, if you look at the bank's holding of CGBs, it's about 66% of the market is held by banks, mainly the big six. So certainly there are some risks. If there's any sell-off in yields, it will hurt their balance sheet. So that's why the PBOC is warning the banks, you have bought enough, you may want to like slow down your purchase or sell some, just because one factor is they're going to issue the special ultra-long CGBs. If that supply just arrives to the market, the yields may actually rebound, and that will hurt them. So they're warning the banks.
Stephen Chu, thank you so much, our Chief Asia FX and Rate Strategist there. Of course, speaking of banks, HSBC comes out with earnings today. Yesterday, ICBC, Bank of China, and Construction Bank came out with earnings. That takes us into this conversation around Chinese equity markets just stopping short of a bull market. We're joined here in set, Wendy Liu, Chief Asia China Equity Strategist at JPMorgan. We've been here before, Wendy. We've gotten our hearts broken many times. Can I believe this rally this time around?
I think this time the rally is supported by an earnings turnaround that we have not seen since the first half of 2021. And the way that the market has traded is very much flows into single stock that had delivered stronger results and with share buybacks and higher dividends. So I think there's more substance to this rally. It's a selective rally.
Selective rally. So what does that mean? We're already up some 20%. For MSCI China, Hang Seng, what can you still chase?
I think if we look at 2023 earnings, there's about 4 sectors that have very strong earnings. So these are consumer discretionary communications, healthcare, and utilities. And there are about 4 that are still negative in terms of year-over-year growth. And so it's very much about where their earnings come through in 2024, particularly 1Q, 2Q results. On the cycle analysis, it would indicate the laggards at some point will turn, and the style may move from value to growth as we move from the early recovery zone to the expansion zone. So I think more of the other sectors may participate. And the way the market traded is that you see people buying the highest quality names in terms of business, sustainability, and then it spreads. So sector by sector, I think this is probably how it's going to unfold.
Let me take you to the most extreme end of that. Yesterday, property shares up, I don't know, 10, 15%. What do you make of that move? What does that signal to you?
I think it's anticipating any policy that could be coming out today, near term, further easing, and particularly there could be buy versus build program. If it's a buy versus build, we don't know the details, but broadly, this would stabilize asset prices. It wouldn't be as favorable to the building activities, but given the weak consumption, a stabilization of property prices may help on the margin.
So beyond just maybe targeted property stimulus, I mean, are you expecting any more that could actually support this rally further, or do you think that we're basically sort of done in terms of the big stimulus?
The question that people raise is that if you do go through a buy instead of build program, how much money is behind that?
Yeah.
And we don't have an answer to that, but that's where the feedback has been coming through. And I think judging from the amount of restrictions that are still in place, you could still see more easing coming through, and it's how the retail market respond to that. Now, granted, the most sensitive market in China has been none other than Shenzhen, and Shenzhen's transaction volume picked up in the months of March, and I think the early signs that market responding to something recovering was Shenzhen, and that's been around for about a month now.
Yeah, I guess just to follow up on property, it's that group of stocks on a market cap basis is such a tiny part of this market anyway. And I'm wondering whether or not should there be a temptation to allocate more to property at this point, just given how small these stocks are anyway at this point in time. Like, what's your sense of how important it is to have property in your portfolio as, I guess, something that delivers alpha?
Yeah, so if you look at our sector analyst view, they do think that there are waves of speculation surrounding easing, and ultimately it's going to be where the demand comes in. If you look at our strategy allocation, we have gone to a neutral because the market cap vis-a-vis sales indicates that the bearish views are well priced in.
Okay.
And I think what's critical is the top 100 developer sales data. Q1, that was deeply negative, okay, double digits. And if that data, based on our sales, our analyst estimate for the sector, could narrow the decline in 2Q and 3Q, and for the full year it will be down by 10%. If that estimate is accurate, then at some point you're going to see an improvement in top 100 developer sales. So I think it's a process where a little bit come through, and then at some point it adds up. So my call is in the second half of this year, property prices in the secondary market will see stabilization because there's 20 million upgrader demand. That's about 6 to 7 million units that is to come through between 23 to 25.
And do you lean towards the domestic market a bit more, or do you think 8 shares offshore, that's sort of where we're going to see more of this momentum?
We've been more positive on H because the earnings upside has primarily come from H, and 3 sectors led that. And these are all POEs that are proactively cutting costs and lifting shareholder returns. They're mostly internet, communication services, consumer discretionary, and then surprisingly healthcare.
Right, and that takes us into flows, right? The Stock Connect almost consistently net buying into Hong Kong. What are they buying? What does data show you? What are the biggest targets? Where's the money coming from?
Yeah, that's being raised as a big question. Where's the money coming from? Who's buying? And it appears to us the buying has focused on quality businesses.
Okay.
There's an element of less about passives, but more about picking businesses.
Okay. You said healthcare has been surprising.
Yeah.
Why so? Are you starting to see a little bit of a bottom being formed, or out of this whole crackdown, obviously, that what people were talking about?
I think there's a lot of regulations against it, but then a year ago, coming out of the pandemic-related lockdowns, you do see earnings improving. Yeah, and so I think this is a sector to watch also. Yeah.
Final question for you. We're at 50. I'm just looking at my charts right now. MSCI China's at 59. The peak was 130. Indulge us. When do we get back to 130? How many years do I have to wait?
Okay. So
Guess
our index target is 66 for this year. Stretch target is 70. I think the coming of the age of China was 06, 07. At that time, MSCI was about 29, 30 times. Okay. Then there was a levered bull, I think you guys remember, in 2015.
Yeah, who could forget?
Yeah. And then it didn't work. And so it's the addition of the internet that really pulled MSCI China out of its doldrum. And so we get the peak that you were talking about. When can it back to that level? That keeps me awake at night. I don't have a good answer. But I think we take one step at a time.
There we go.
All right. Wendy, thank you. Always the optimist. Wendy Liu there, JPMorgan Chief Asia and China Equity Strategist, joining us there from JPMorgan. Of course, your fix just crossing here at 710.63. So another solid day with that fix held at that level here. And we're seeing a little bit of a, I guess, weakness there, but really it's marginal, 724.66. Really there against the dollar today. Dave.
Yep. Coming up here, spot crypto ETFs are set to debut in Hong Kong in just a couple of minutes. And of course, Bell is with us out of Hong Kong exchanges. Bell.
Dave, Yvonne, I hope you can just get a little bit of a glimpse of what's going on behind me, but the listing ceremony is underway right now for the 6 new ETF products that are coming to market. So there's 3 spot Bitcoin ETFs, there's 3 spot Ether ETFs, which is one to note as well because they're currently restricted from trading in the US sessions. This is very new for Hong Kong, of course, a city that's trying to develop itself as a digital asset hub on an international scale. Still up, a lot of really great interviews ahead. We're going to speak with each of the issuers here this morning. ChinaAMC, Key Capital, and also Harvest Global Investments as well. Those big interviews coming up as we're also hearing that nearly 300 million has come through in the initial investments. That's Hong Kong dollars, so just under the 40 million US dollar mark. Some of those big interviews are ahead. This is Bloomberg.
Just over 10 minutes away from the opening bell, we're watching property stocks specifically today, 20% from Friday. What a move that we got. Now, earnings are coming through as well. Yeah, one of the biggest ones, China Vanke, has recorded a second consecutive quarterly loss. It does add, of course, to financial challenges there as it struggles with slumping sales and, of course, its cash crunch. Patrick Wong, our Bloomberg Intelligence senior analyst, is here with us to talk us through his analysis and initial take of the numbers.
Yeah, the thing is that for Vanke, I think first quarter we see the earnings is even worse, right? We see the profit for quarterly basis is another decline, right? It's a negative. So basically the loss I think is driven by the profit margin, which is just like for gross margin is just 10%, right? Versus previously we have 16% or even 20%. So it looks like the contract sales coming down, the property sales is weakening prices, so that is also impacting the earnings already.
Your team has been talking about this plunge in cash coverage of short-term debt. It's basically has plummeted to 98%. And I think it was 151% at the end of last year. What does that signal to you then? What moves can they still do now?
Yeah, when we see the cash coverage, right, for the short-term debt is coming down further, so which is a bigger impact. And we see also, we have some discussion about whether the Shenzhen Metro could help Vanke. But having said that, I think Shenzhen Metro, the cash coverage even worse is 0.6, right? So it's difficult to see whether the bigger shareholder can really help Vanke on that point.
Right. So we heard a back and forth between a ratings agency, who will go unnamed, but I guess people on the street know it, and the company hitting back at the ratings agency. Who's right? They're both right. They're both wrong. What's default risk looking like here for the company, given cash coverage that you just talked about?
Yeah, I think they need to really sell more stuff from them. Like, for example, I think there's some discussion about the potential stake sales for the GLP, right? So they bought it a couple of years ago for 2.5 billion US. So that is something that they could sell and then buy some time for them to save the company, right?
Is a bailout still something that we need to factor in, or maybe a possibility right now? Would the government show some support to avoid a default now for Vanke?
I think they still need to get some support from them. For example, like bank loan, and also for the bailout, I think that perspective, we need to see whether the contract sales could come down further or not, which honestly, I think the sales could dumb down further in April versus March for Vanke. So it's still a bit trouble for them.
Okay. Patrick Wong, thank you. We didn't even talk about this crazy rally that we saw.
Crazy.
In property stocks. We'll see if we see another day of it.
Crazy.
As well. And does the Vanke story actually impact that here today? Another story that we're watching, of course, is what impact has on the banks as well. You take a look at the earnings that we got yesterday. Doesn't look like they're escaping the impact of the country's property crisis. You take a look at ICBC and Agbank, both reported their first decline in quarterly profit in more than a year. Bank of China and CCB also delivered lower first quarter net income. Chinese lenders are facing a prolonged squeeze that has narrow margins to record lows, while Beijing calls for lower lending rates and beefed up lending support.
Yep, here we go. Going into the open, 0.5% to the upside. So the bull market threshold still within striking distance this Tuesday. Opening bell, 7 minutes away. You're watching The China Show.
All right, some stocks to watch. Already seeing L'Occitane now resuming trade after announcing that it will be taken private here. This is a skincare company, of course, and you're seeing now the share popping about 13% after being suspended for about 15 days or so. The offering is $34 a share, so that was actually a premium about north of 60% from the 60-day undisturbed share price, of course. So certainly there was a premium there. That's why the share's flying today.
Yep. As far as earnings go, a lot to look out for as far as earnings reaction in terms of what is on deck today. So Yum China came out a few hours back. HSBC comes out a few hours later. Yum China, I think, missed on revenue but beat in earnings. BYD came out yesterday as well, and we talked about Vanke already, or Vanke. Big banks which did come out, ICBC, Bank of China, CCB, and we talked about HSBC. And also, I think, since HSBC's earnings are coming out, Hang Seng Bank, I think, should also be coming out today as well. Quarter 1% to the upside on Huifeng, HSBC. There we go.
All right. We'll see if we see another mega day here and whether we get to that bull market when it comes to the Hang Seng. We just fell short of that yesterday here, but we're seeing some decent gains across the board in the pre-market there. HS Tech up 0.8%. And H shares also catching a slight bid. We got the open coming up next and PMI data due. This is Bloomberg. All right, it's the big launch here today in Hong Kong. We're talking about, of course, those Bitcoin ETFs. There you go. They're just getting ready to bang that gong here this morning. So we're talking about a batch of ETFs. You can invest directly in crypto. That's the debut here today. Really potentially beating out and maybe even getting a leg up to what we've been seeing here, the potential competition for U.S. Bitcoin products as well, which, of course, has stoked that record rally in, of course, Bitcoin of late here. So will that momentum continue? We'll see how this all plays out. Of course, Dave, we also have those PMI numbers coming out any second now.
Yeah, in 9 seconds or so alongside the open, which initial pricing suggested that we are going to get some upside on the Hang Seng Index. We almost crossed the threshold in terms of 20% from the bottom, the January bottom on MSCI China on the Hang Seng Index, which would indicate us entering a bull market, although the downtrend, of course, you have to go all the way back a few years to go back to the top. But certainly momentum is to the upside, 6/10 at 1%. So we did lose a little bit of momentum into the close yesterday. We're looking at some of these property developers as well, so keep an eye on that after, a 10-15% rise yesterday. HS Tech is up. We're in the thick of earnings season, small caps. And, of course, it's a separate conversation, which we can get into a bit later on as far as the 10-year yield and 30-year yield is concerned. And certainly warnings based on our reporting on the PBOC telling its banks, watch your holdings of CGBs, given where price is, and it's really gone in one direction.
Yeah.
I think we have some data coming out right now.
So the PMI number just coming out, a bit of a surprise here for both. So manufacturing PMI, 50.4. So it is a moderation from the previous month, but still beating expectations here and a second straight month of expansion. You take a look at the non-manufacturing numbers, that was actually more of a miss. We're talking 51.2 now. The survey was asking for something about 52.3 or so. So certainly a miss on the non-manufacturing and a beat when it comes to the manufacturing side of things. Let's get to our guest, Helen Qiao, Chief Greater China Economist of BofA. Your take on these numbers so far, Helen?
I would say that the manufacturing side of the PMI seems to be holding up reasonably well. We were not expecting a number that is higher than last month, mainly because that the March PMIs usually are subject to more seasonality impact after the Lunar New Year. So historically, it always ticks up. So you shouldn't be taking the full, amount of the upbeat numbers from March as the full amount of improvement in momentum. But in April, always, usually that will slow down a little bit. So actually, we were expecting a 50.2, and the result is slightly better than that. And the beat, I think, is still pretty encouraging. It's consistent with the fact that first quarter data were actually showing more catch up already on the investment and the industrial side.
Yeah, and if I haven't seen the subcomponents yet, but are you curious to see any specific subcomponents of PMI?
Yes, I would say that on the industrial production side, the production activities would probably be most important to watch. But at the same time, people would be watching for new orders and also exports side. And I would say that if they are holding up reasonably well, then that's probably opening door to actually a strong set of numbers for second quarter. This is because, David, that last year, second quarter has a very low base. And if sequential, which is PMI, is telling us that its growth momentum holds up reasonably okay, in year-on-year terms, this is going to translate into much better year-on-year numbers. So that is going to be, a potential more positive news to support the market.
It seems to be more of a slowing in non-manufacturing. I mean, you mentioned the seasonality that might be leading to this drag, but is there anything more beyond that than you think?
Yeah, the non-manufacturing or service PMI is slightly different. It is not subject to the same amount of seasonality as in the manufacturing PMI. But I would say that there was this very evident dichotomy in the economy where you see a lot of the drives are actually coming from the service in 2023. But this year, that is slowing down a little bit and then more changing gear and turning into the manufacturing side for goods consumption. I think that's actually a good thing. It is also suggested that potentially this is driven by also stronger investment. So by comparison, more resources have been now diverted towards the manufacturing investment side of the things. So that's a potential positive change, and that is in line with our expectation.
There's been a very strong rally in the Chinese bond market, maybe partly on expectations that the economy or rates continue to fall and the economy perhaps doesn't rebound as quickly. What's the course of travel, direction of travel in the economy? Should we still chase the CGB rally?
Well, I think that particular rally has been thwarted somehow in the past few days.
Yes,
Not the least because of all the the PBOC's expressions about this is not a QE suggestion, and also the very fact that people were expecting maybe a little bit stronger growth after seeing a bit better numbers. And also yesterday, I think the street talk you probably all saw about the the Politburo meeting coming tonight will be quite important to watch, because if that turns out to be true, which indicates a potential turnaround of property policies, then probably the bond buyers may not necessarily be as bullish, because that may imply a faster growth restoration.
And what would we expect in terms of any sort of property stimulus? Is it something that's more going to be broader? What are you expecting? We've seen home relaxation, restrictions being lifted. Is this something that could be more nationwide? Or maybe even eliminate, property tax. I mean, people are talking about property taxes and the like, but what would you be expecting?
We are keeping our fingers crossed for more policy easing, especially in terms of relaxing those demand restricting policies and more broadly, as you said, on a national basis, right? I think so far we have seen very sporadically, and painstakingly one city after the other. And also, sometimes it may actually just be a very minute change. For example, whether divorcees would be considered eligible right away, right after divorce or 3 years later. So those kind of adjustments in our view are very limited, and we certainly need to see a more aggressive way of relaxing more. And now I think the rumors are that we're seeing more tier 2 cities joining and completely opening up their property eligibility, property demand eligibility requirement. But at the same time, are we going to see more, for example, going to tier 1 cities? That I think it would be key to watch in the near future. Of course, what people are now wondering, and the reason why the property names jumped so much yesterday was that some of them were hoping that the government is going to turn around and buy up more unsold inventory. If that's the case, then their liquidity may improve right away.
The buy versus build.
Buy versus build, yeah.
Well, that takes us to, what does it mean? How good can growth get if we do get something along that policy prescription on property? You have a 5% target right now, projection. How good can things get, all things considered?
Well, good question. We just upgraded our GDP growth forecast about 2.5 weeks ago and to currently 5%. So we think that there is still pretty balanced risk on either side, because I do think that, as you said, probably a more a resolute action on the property side, and also at the same time maybe better funding and more progress on the infrastructure investment side will potentially give us more upside. But at the same time, I think that potentially the risks are also, especially in the second half, if trade protection as a risk is going to revisit, and the external demand may wither somewhat. So compared to the upside, I would say the downside is also reasonably large, and therefore I would say that right now 5% is probably where we're comfortably sitting on, and that is the target after all for this year. And there's no need for policymakers to do too much more to impress anyone.
Okay, so you're not expecting further policy easing. I mean, does the Fed factor also become a big sort of factor as well? The fact that they keep delaying these rate cuts, it seems, or at least markets are pricing in that?
You hit the nail exactly on the head, and Yvonne. The thing is that we are expecting more policy easing, but probably less monetary easing, especially by way of, let's say, interest rate cut through one-year LPR compared to, otherwise. Because we were hoping that the PBOC could have more room to do more things in this year, primarily because that funding cost is still high in China at a time when inflation is really low. So in real terms, that is actually, unbelievably high from an Asian context perspective. But the problem is that with the Fed probably postponing their potential cut all the way to December, that's our house view, maybe at most a 25 basis point of a cut in December, and also with the 25% probability that they do not cut at all, then that implies probably not only for PBOC in general, central banks in Asia would have less room for easing because of the concerns on the exchange rate. Yeah. So far, I think the yen has depreciated the most. None of the other Asian currencies has followed as much. Yeah. But the risks are that if they go further, how much more depreciation we shall see in this region.
There was talk, I think about two weeks back, that maybe the window for the PBOC to reduce rates would be when the ECB does, June or July. Let's say they do that, and let's say the Fed moves 6 months down the road in December. How much damage do you think that's going to do to the currency, the Chinese currency?
Well, I don't necessarily think that cutting the interest rate would be, just introducing more externalities on the negative side, in the sense that it also lowers the domestic funding cost, and that's probably going to buy a little bit more time and get the domestic demand boosted a bit better. But if they actually look for that opportunity for ECB to do something and then make a move on the back of that, I would say that would probably be a signal not only for, China, but also for the whole FX market in Asia, because effectively not only North Asia, look at Korea, Taiwan, and but also the entire Southeast Asia. I think everybody is actually watching the anchoring impact from the renminbi. But if renminbi actually goes much lower from the current level, that's potentially a signal for others to depreciate a bit more, a bit less reluctantly, let's say.
And, sorry, very quickly. This mini devaluation conversation, is that nonsense in your view?
You mean a one-off?
Yeah. Or? Well, whatever definition you think.
Well, but it could be in different ways, right? If it is a slow but gradual depreciation, I think it's justifiable from RER or NER perspective. But if it is a one-off, I think that is much more difficult to execute.
All right, Helen, I believe you have to go do radio now, so we got to get you off the set. Helen Qiao, Chief Greater China Economist of BofA Global Research as well. You're watching stocks, Dave.
Yeah, earnings. BYD was out with earnings. Vanke, Yum China this morning. Long E Green actually posted a substantial, I think it was loss and a drop there as well. So we're down 4% on Long E Green. Checking the banks as well. Flip the page, please. I think 3 of the big 4 came out with earnings. HSBC comes out today, and we'll leave you with a look at property counters after that massive rally we had on Monday. Mixed MSCI China real estate maybe down to index composition here, 4.4% to the upside still. Or maybe this is update now. Anyway, we'll get you more details on this in a moment. Plenty more ahead. This is Bloomberg.
All right, we're checking, of course, one stock in particular, Baidu, on the back of what we saw that Tesla jumped some double digits yesterday on the back of this trip that Elon Musk made in China, which really kind of paid some dividends, right? I mean, you take a look at what they saw with this potential deal, talking about how they're going to work together to deploy its driver assistance system in China. We're seeing Baidu up for a second day. BYD, though, those earnings came out also, too, Dave.
Yeah, markets are kind of yawning. It was a good day, by the way, also yesterday for a lot of these stocks here in Hong Kong. Let's bring in Peter Vercoe, our Global Business Asia editor, with us right now. Peter, let's start with Tesla and the Baidu story. Certainly there's an argument to be made, more maybe a Tesla than a Baidu story, but give us your take and those approvals that we did get around this time yesterday.
Yeah, obviously a big win for Tesla, and that Elon Musk's quick trip to Beijing on Sunday has paid off. Clearly Tesla needed something to give it a new competitive edge in China. It's facing stiffer competition from the likes of BYD, Li Auto. You've got Huawei's Xiaomi coming into the EV market there with cars. And Tesla's only real strategy over the past year has been to continue to cut prices. And eventually that was going to reach a point where they couldn't cut anymore without taking a big hit on margins and profitability. So I think the reaction that we saw in Tesla shares overnight shows just how big a deal this is for them. Investors obviously very welcome this move because this gives them the opportunity to roll out assisted driving software in China and gives them a new selling point and a new competitive edge in what is, in a market where EV growth overall is slowing and Tesla has been losing market share.
And one more before we get to BYD. I mean, the data security concerns. I mean, obviously we've heard that with ByteDance and TikTok. Is Tesla about to kind of embark into that sort of debate as well between the U.S. and China right now on this deal?
Yeah, it's a little hard to see where we are because details are still, there hasn't been a lot of details given on this in terms of around when and in what format Tesla will be allowed to or be able to roll out its driver assistance packages. But the fact that it won this data security sort of clearance or approval also a big step because, we've seen in the past that Tesla's cars have been banned from military sites, from government compounds in China. So it does seem to be, maybe a little bit of an olive branch there from the Chinese government towards Tesla, being able to get back into those areas, which obviously is going to be needed for autonomous driving.
Peter, thank you. Peter Vercoe there, our Global Business Asia editor. Staying on theme here, Tesla's potential entry into the Chinese market with FSD. Its system specifically was certainly cheered by investors, up 15% overnight. Now, Musk will also face plenty of domestic competition. Stephen Engel, our Chief North Asia correspondent, joins us right now from the Beijing offices, in fact, of perhaps one of those competitors, Pony.ai, which is already running robotaxi fleets in China with its partner, Toyota. Steve, what can you tell us about this exercise and endeavor?
Yeah, that's right. I mean, they've been doing these on-road testings. I'm talking about Pony.ai for the last 6 years. In fact, they've been running actual real-time taxi services in this particular district, Yizhuang district, down in southern Beijing for the last year and a half. It's about 80 square kilometer area where you can hail a robo-taxi without a driver with your app, and then they will take you to your destination as long as it's within this 80 square kilometers. Now, in fact, there's 60 square kilometers. There's a bigger district where they're also doing the same thing down in Guangzhou, in Nansha district. It's some 800 square kilometers. enough about me. Let's talk about the car, because that's what we're here for. This is the particular latest generation model, the 6th generation model. It's a Toyota Sienna, and it looks like a normal Sienna from Toyota, but it is packed with the AI and the systems and software from Pony.ai. There are, in this particular model, 11 cameras. As you can see, this is one of them on the side. This is a radar panel here as well. We can come to the front of the car and see also more of the technology. A couple of more cameras. As I said, there are 11 in total in this car. This is radar here, and up here is in this latest generation, more of an integrated LiDAR, radar, and camera system up on the top. Essentially, you hail the taxi on your app, it arrives without a driver, and you get in. If the cameraman can come with me this way, he asked me not to go too far, but essentially you get in. There's another screen in here where you put in your destination, you confirm your identity, and it takes you to where you want to go.
Wow. So cool, Steve. Okay, so Pony.ai is doing that. Who else in China is developing rival systems to the FSD?
Everyone, right? I mean, if Tesla is coming in with full force, I mean, essentially after the first quarter results, they said if you believe that essentially EVs are the future, autonomous is even more so. And I'm paraphrasing. But again, you look at, I have the list of the other Chinese companies. They're the who's who of the EVs that we saw last week at the auto show. BYD is investing lots of money. Also, NIO has its NOP Plus system that they are developing. XPeng has the City Navigation Guided Pilot, NGP. It began trials in 2022. And no doubt the big tech companies that we saw there at the auto show. Xiaomi coming out with its first car, the SU7. It's going to be loaded as well with its driver assistance autonomous programs. I believe it's going to be available as of August. And Huawei has its ADS systems. And Huawei doesn't have a branded car, but they have multiple partners in manufacturing and technology and other car makers where it's Huawei inside. So they are, without a doubt, building out its autonomous driving capabilities that will go into cars. So there's lots and lots of competition, Elon Musk, here in the market. He sees it, but he believes, obviously, his FSD system is a game changer, as we heard yesterday from Dan Ives, the analyst, who says this is a game changer for Tesla, but he's going to have stiff competition. Let's face the fact.
Yeah, that's what our Robert Lee from BI says. Just the cutthroat competition that we're seeing in China right now. Steve, thanks so much for showing it to us as well. Our very own Chief North Asia correspondent, Stephen Ingles, joining us out of Beijing. Just want to recap those China PMI numbers that just came through in the last minute or so. 51.4, so another beat when it comes to the manufacturing side of things here, and really kind of matching the sort of maybe potential trend that we're seeing when it comes to the official numbers as well. So 51.4, 50.4 for the official PMI. You are actually seeing a bit of a reversal in the Hang Seng. We were losing a bit of momentum, but just after those numbers came through, seeing a little bit more upside here today. We're up about 82 points right now. Plenty more ahead. This is Bloomberg. Welcome back. You're watching the China Show. Just want to recap that PMI data. So it looks like you're starting to see this recovery at least hold when it comes to the manufacturing side as well, right? You take a look at the manufacturing of the Caixin and the official, both were beats. The miss was a non-manufacturing of 51.2, so by a large margin, mind you. But certainly you are seeing maybe signs of fundamentals are actually maybe looking a little bit better, at least a second straight month of expansion when it comes to the manufacturing side, Dave.
Yeah, it's consistent with some of the commentary we're getting on the equity side and the earnings side that we are, in fact, finally this quarter seeing a positive earnings revision quarter on quarter. So maybe it might be in line with what we're seeing in the economy here taking place. Here's a look underneath the hood and some of the major subcomponents. And you are getting a pickup in output. That's number one. A drop in new orders, though. A slight pickup as well, at least as far as the beat is concerned, only 1 out of the 5. It does seem where we are getting a pickup. On the overall figure, as we were just pointing out, though, a beat on both. Now, as we wrap up the month, it's been a fantastic one for Hong Kong markets in particular. We're now looking at 48 sessions in the last 49 of net buying across the Stock Connect coming through to Hong Kong. It's certainly been a big piece of the conversation based on JPMorgan, who joined us on shows earlier on, and saying it's really a big question. Where is the money coming from? What are they buying? And what they're seeing is they're buying into quality companies with good growth prospects and a good balance sheet. But I mean, why would you buy anything on?
Well, so far,
venturing.
I mean, it's like you look at investors in China, they switch from maybe buying gold, which was certainly a safe haven.
Yeah.
And now it's more like tech and property stocks, which is what we've seen a lot of what's driving these stellar gains for the past few weeks or so. So certainly that's one thing we're watching very closely, especially given we have this Politburo meeting tonight, which we haven't talked too much about, that maybe we'll see some more policies targeted at the real estate sector, maybe, right?
Yeah. So far it's market chatter. Yeah, the buy versus build, buy in terms of some of the units particularly, which alleviates some of the concerns right now. So it could actually add to this total you're seeing on your screens, nearly 190 billion Hong Kong dollars bought in Hong Kong shares. Some of that really went into property yesterday. Lots more coming up here. You're watching The China Show.
Welcome back to the China Show. Here's a look at the HSI, just a half hour into the session here, and we're teetering around those gains here. We're getting ever closer, though, to that bull market territory here. Just keep in mind, 17,953 is when we do hit that 20% gain from those January lows. So let's see, we get it today. Yesterday, we fell short of that just a little bit, losing a bit of momentum towards the end of trade. Right now, we're focusing on multiple things. There's chatter, Dave, of a Politburo meeting tonight. No readout yet, but those PMI numbers, especially on the manufacturing side, looking strong.
Yeah, and markets are talking about it. Certainly a large part of this market. In fact, when you look at the price action yesterday, and I only have to talk about that group, those gains we had in property, for example, didn't really need sort of any sufficient, by in fact this is happening and by and large this is happening, factual, concrete evidence that it's happening, and really speculation, right? That maybe, just maybe, we could be getting a turn as far as regulations concerned. It's a big maybe as well. We're endeavoring, of course, to get to the bottom of that. All that being said, there was a rally yesterday. There is still a rally taking place to a lesser extent, taking place right now. Maybe part and parcel to that sort of story is all the information coming through based on our reporting in China's bond market. Hence, we're looking at yields coming down a little bit after 4 days of quite a steep jump on a lot of these things, right? So the PBOC, effectively, when you look at Chinese banks, for example, based on our reporting, telling the banks, hey, watch what you're sitting on as far as these bonds are concerned. If they get too expensive, it becomes then, of course, a problem when the economy recovers and then price goes the opposite way. Case in point, March of last year, some of the U.S. banks were sitting on treasuries, for example, and then that move in treasuries happened as well. Anyway, I digress. Let's change things up, please. Speaking of property, 10-15% move up yesterday. We're seeing declines today and maybe some profit being taken off the table. We did have some earnings, of course, coming through out of one of the bigger ones here. Very quickly, a glance at the mood music across the region. Japan is coming back online today, so you are getting a catch up there. Asia up overall 0.7 to 1% yesterday, 1.6% across Japan. We even haven't talked about Samsung earnings. The breakdown came through a couple of hours back. 10-year yield and 2-year yield on the way down a little bit right now, but all that being said, it's looking like a stronger dollar story. And as you can see, we're back to about 157 here on dollar yen. We did come, of course, from 160 in that big move yesterday. Maybe someone did something. Who knows? Yeah,
we still don't know, right? No. We might know at the end of next month, not even this month. So that's according to Kanda this morning. So does it mean they did it? Will we know? Well, yes, we can't confirm it just yet. Let's get to Mary Nicola, our MLive strategist, on just this incredible sort of collapse that we saw in yen yesterday. I mean, are these moves likely to hold? What is positioning telling you now, Mary?
Yeah, there's a lot of headwinds still to come, especially for dollar yen. So if you take, for example, you still have the FOMC meeting where the expectation is that Fed Chair Powell is likely to strike a hawkish tone. You still have the labor market report that's on Friday. So there's a number of headwinds coming through that if they send short-term U.S. Treasury yields, the 2-year up higher, that's going to have an impact on dollar yen and also push it higher. So it's dollar yen. It's definitely not out of the woods just yet, because the external headwinds are still going to be a lot stronger than some of what the moves that we've seen over the yesterday, for example.
Right. Mary, just to turn our attention now to the other big story this part of the world, is this rally taking place in greater Chinese equity markets. PMI numbers were not a blowout, but decent. Do you think this should be enough to at least give bulls something to latch on to today?
I think so. I think if you look at, especially on the manufacturing PMI data, because it was such a streak of contractionary numbers for so long, and now you've got 2 consecutive numbers that are in positive territory. So that should give the markets something to cheer about, and especially from the fundamental side. The services disappointed, and they came slower, but again, we're still in expansion territory. So for now, it should be enough to sustain the rally, but the numbers are going to need further follow through. So the slew of data, the barrage of data that's coming through from China next month is going to have to solidify that there is still fundamental support to sustain this rally.
And also earnings, Mary, not just in the U.S., right? We'll need to see these Chinese corporates start to deliver the fundamentals.
Absolutely. I think that's one. But at the same time, expectations have been so beaten down. So there's, to some degree, there could be a very low bar that they have to fill. But at the same time, we need to see that fundamental support not only from earnings but also from the economy. But at the end of the day, the economy has been a big part in terms of really garnering the support, especially from foreign investors, that China's out of the woods, that it's turning a corner, that there is sustainable growth coming through. So it is a combination of earnings, but the growth really does have to deliver.
So that brings us to the question of the day. You're asking our audience, is it going to be DM or EM that's going to outperform next month? What's your take then?
Yeah, it looks like, famous last words, but it looks like EM could be the one to shine heading into into May, especially because we see that if the China rally still has more to go, that we could see some regulatory support continuing. It is very under-owned. It's very cheap. So there is still a lot of fundamentals behind it that could support it. So there's still plenty of upside that we could see from emerging market equities, and DM still has earnings to prove, and the earnings need to come through. That it's definitely going to be a lot stronger and be able to overcome that rise in yields in the U.S.
Mary, thank you so much. Our MLive strategist there for our Bloomberg viewers and clients. Do chime in, of course. That's a 50-50% probability anyway, EM or DM. Okay, let's talk more about the EM part of the conversation. PMI's out of China about 36 minutes back. On the official numbers, also the private numbers from Caixin out, both a beat there. Let's bring in David Chu, of course, here and set with us, our Bloomberg economics economist, to talk us through his initial take on the PMI numbers.
Well, if you read the headline numbers, the numbers are okay, fine, because the retreat due to the seasonality was not so strong as last year, so that it was the good side. But on the other hand, if you look into the details of the data set, you would find that the concern about the consumption side remains strong, because if you look at the demand side indicators and also the service sector PMI, you would find that the consumption is still weak. Yeah, which is a long-term concern for us.
I think Helen Qiao was just now from BofA saying even if there is weakness in the non-manufacturing side, as long as manufacturing holds up, we're still going to be okay. That's why they still think 5% this year is achievable. You guys revised your forecast just recently too, and you don't think 5% is achievable at this point.
Well, we don't say achievable or not, we say, okay, there is strong challenge ahead if we want to achieve the 5% target because of this so many headwinds.
Sure.
Yeah, speaking of Helen Qiao, of course, we spoke at her earlier on. Just for our viewers who missed that sort of crucial part of the conversation, let's play that out and we'll talk about it on the back of it. Let's play that out, guys.
The Politburo meeting coming tonight will be quite important to watch, because if that turns out to be true, which indicates a potential turnaround of property policies, then probably the bond buyers may not necessarily be as bullish, because that may imply a faster growth restoration.
And I guess, David, just for context, the question we asked Helen in that answer was, the CGB rally has been relentless up until recently. Yields have been pushing lower, and the government's come out and has warned that some of the bond pricing has been divorced from fundamentals. If, in case the economy recovers and if the housing market recovers, bond yields shoot up as well. Where's your head on how good the recovery can get, and whether or not we could expect any big announcements if, in fact, a Politburo meeting is, in fact, taking place today?
Okay, I think we should talk about this from two levels. One is how likely we're going to see a big policy in the property market. Well, for this side, we need to. We all know that it is talked that the government is trying to establish a new unit to purchase the housing or inventories from the market. But to do this, well, we don't know whether they are going to do it. But to do it, I think there are two problems they need to solve. One is how much, the size or the scale of the fund. Two is where to get the money, right? So that we all know that the fiscal side is a bit tight these years because of the rot in the housing market. So where to get the money is a key question. And the second, a following up question is, at what prices the government buy it, right? If the government buy it with a big discount, that would also be an impact to the housing market.
Yeah.
So that is the first thing. The second thing is that if the government do so, they buy the inventories from the market, whether it could change the supply and demand relationship in the market. Well, I really doubt it, because even the government purchased it, they cannot destroy the housing after purchasing it, right? They still need to use the housing in some kind of forms. Yeah. For example, they can use it as affordable housing, or they can use it for rental. To rent to the people who need it. So it is the supply is still in the market, and the key problem in our mind in China's housing market is oversupply. Yeah. So that if you cannot decrease the supply, it means that you cannot change the supply-demand relationship.
Can't turn it around. All right, David, that's a good perspective there. Good point. David Chu there from Bloomberg Economics joining us there on what could be, right? We were just this market chatter of a buy versus build sort of program. Well, still ahead on the China Show, our exclusive interview with the CEO of ChinaAMC as their spot crypto ETF launches here in Hong Kong. Hear what they see and where they see the demand coming from. Next, this is Bloomberg.
Welcome back to the China Show. Yep, it's a milestone day here in Hong Kong. Spots, crypto ETFs have begun trade about a couple of minutes back here, of course, along with the session. And look at 3, and of course you have a few more coming online today. So maybe not the best first day at school, but of course we typically end up in a better form, of course, after you go through many more years of school compared to how we came in kindergarten. I don't know what I'm saying, but I think that's enough of the nonsense now.
Let's get to Belle. She's standing by with one of the issuers at the Hong Kong Stock Exchange. Belle, take it away.
Yeah, thanks, guys. As you said, it is a pretty big day here in Hong Kong. We just had the start of trade for 6 different ETFs that are coming to market, going live. 3 spot Bitcoin Ether, 3 spot Ether ETFs as well. But I'm speaking with the biggest of the issuers. This is ChinaAMC CEO Yimei Li this morning. Yimei, thanks for joining us. And we were just discussing then about the amount of inflows they're actually expecting. And you said by the end of today, you could be north of 125 million US dollars.
We are confident, but we will see the market response. But I think we are very optimistic about today's inflows and also the investors' attention to this product. It's a big day here in Hong Kong. And also, I think in the whole capital market in China.
So, of course, it's not just the inflows that come in today. You also would have had placement beforehand, more from private investors. So where did that sort of demand come from?
I think we have various investors. We have certainly the investors from all the Bitcoin universe. And also we are very happy to see a lot of traditional investors who are interested, have been interested in the Bitcoin and has no instruments actually to invest in the Bitcoin. So we have seen various interests from different investors, and it has been very, very inspiring.
Investors that are based here in the city, or are they based elsewhere?
Well, definitely mostly based in the city, but we also have been seeing interest from elsewhere.
Because what is one of the key points of difference with your ETF is that it's also available in CNY. So what sort of yuan demand have you seen so far?
Well, now I definitely think that opens the door for a lot of, RMB holders who really needs a very alternative way in investing. But now the mainland China investors cannot directly invest in Hong Kong yet. So we hope that in the future there could also be a, new opportunity for them to participate in this process.
Yeah, I mean, I think what you're referring to there is the ETF Connect program.
Yes.
And so when would you see these crypto ETFs being included into that program, do you think?
Well, frankly speaking, I don't see it happening in the short run because now the ETF Connect is limited to the Stock Connect universe. But as the opening up progress, we definitely hope that multi-assets will be available for domestic investors.
And out of the CNY demand that you're seeing so far, how much would that be in proportion to, say, inflows that are coming in HKD or USD?
Well, now I don't have the final number yet, but I think now it won't be the mainstream, but we'll see how the market progress.
This is sort of I'm not going to say vanilla product, but it's one of the most simple ones, I guess, the spot crypto we had as well already, the futures ones. But there is a lot of demand out there for more structured projects, levered, inverse, for instance. When would you start looking at those? Or are you already looking at those?
Yeah, definitely. We are always, getting ready for new products, and but we have to do it step by step. I think now creating the in-kind creation is already the first in the globe, right? So we are going to do this very concrete and do this right. And then we can moving forward to the next section of new innovations in our Bitcoin or Ether ETF product.
Okay, we can get more on the products then. Let's just stick with in-kind redemption because that is a way that makes it cheaper for you to issue these ETFs. Is that right?
Yes. I think it's very important in the sense that it really links the current market to the whole Bitcoin universe.
And so the cost that you have, though, because actually your ETF is the most expensive out of the three, the management fee, 99 basis points. So how do you see that comparing when you've got the others that are free at this point in time?
Well, I think our pricing is very typical. It's not like we have a different pricing guideline. We are very typical for alternative ETFs in Hong Kong. And also, I just felt like this is such a new product, and there's a whole ecological system that we have to nurture in the beginning. And ChinaAMC, we are going to invest heavily and strategically in this area. So I think as the market progress, we can also see the fee structure progress. But now we are the typical pricing for this kind of ETF in Hong Kong.
But the fee structure, if you're saying that you're going to review that, what would be the review time frame, for instance? When would you look to reassess? 6 months, in a year's time? What's the sort of timeline?
Yeah, we don't really have that kind of timeline, but definitely we will listen to our clients because we will always put our clients' needs at our heart. So we will see how the clients are going to react to different fee structure and how that will affect the whole ecological system.
would you have the capacity to enter or to issue a fee or offer a fee that's comparable to the others?
Well, I don't think it's a matter of capacity. Like I said, it's a pricing scheme that is very typical, and also it has been for every other alternative ETF in Hong Kong. Yeah.
But if you do have a lot of demand and you've got a lot of clients that are saying, really want to invest in your product, but I've got others that are free right now, would you also offer free? Would you be open to that, or going to a very low fee structure?
Well, we will keep an open mind, but definitely, like I said, we will look at what's the best for our clients and also what's the best for the whole ecological system.
Again, listening to clients, what are the sorts of products that you're hearing that they want at this point in time?
Well, definitely, I think from a domestic point of view, people really want to diversify their asset allocation. And from the international or from, the foreign point of view, I definitely think people are getting more interested in Chinese assets, but very different and very specified Chinese assets.
Which assets in particular are you referring to there?
Yeah, I think normally we can see international investors invest in the core and in the Brent West, ETFs like CSI 300. But now we have been seeing more demand into the tech area, into the new energy area. So people are having more desire for the thematic or industry ETFs. So which ChinaAMC have been providing and creating very, very aggressively right now.
So more thematic in ETFs, and then also in the crypto space, which digital assets would it be, like a basket of tokens, for instance? Which ones are you looking at in particular?
I think what you mentioned is really interesting, because a basket of crypto in the future might be more of a diversification for the whole investor as well. So that's also a possibility we will be looking at.
All right, Yimei, thanks so much for your time this morning. As we said, really big morning here. We've just had 6 different ETFs going live, and ChinaAMC being the biggest issuer in the market. Dave, Yvonne.
There we go. Yimei Li there, the boss at ChinaAMC, with Bell at the floor of the Hong Kong Stock Exchange there. If you are a Bloomberg subscriber, you can catch that interview or others that you might have missed these last few hours or so. Check it out, TV Go, on your terminal. There's Bell, of course, earlier on. Join the conversation. Send us instant messages to our team and our guests during our live shows. Check it out on your terminals. Ooh, who is that?
Who's that stud?
Yeah, who is he? Is he single? We don't know. This is Bloomberg.
Here's some of the stories we're following for you today. Ronald Geiger, the billionaire owner of L'Occitane, is offering 34 Hong Kong dollars apiece for shares he doesn't already own. The take-private deal values the company at nearly $6.5 billion. Geiger will fund the buyout with financing from Blackstone and Goldman Sachs. External debt will also be provided by Credit Agricole. Paramount Global has replaced the CEO, Bob Bakish, with a management committee headed by 3 senior executives. The media giant is negotiating a possible merger with independent producer Skydance, led by David Ellison. Separately, Paramount reported first quarter earnings that beat estimates on the back of Super Bowl ad sales and improving results from its streaming service.
Yeah, just checking shares of L'Occitane right now on the back of that news, up 10.5%. We were up 13%. One of the many movers in this market to the upside. Hang Seng, and they're coming off highs a little bit, but as things stand, on track for a 7th day of gains, which would be the longest one going back to Feb of 2021. Maybe earnings have to do with this when you get decent set of numbers coming out. PetroChina, PSBC, ICBC, and some of the big ones coming through as well. And Midea, of course, which is an appliance maker, double-digit earnings growth. That stock is leading at this specific group here, 3.4%. On its Shenzhen listing. Right, one set of earnings that we're focusing on as well, the breakdown in Samsung, and shares are up 1.5% over in Seoul, helping lift that overall benchmark, and we're better by 1.7% as far as Samsung is concerned. We're coming off a day of, 2 days, so this is now 3 days of gains as far as that's concerned. This AI boom reversing some of the losses in the chip sector here. So we're looking at net income, 6.6 trillion won. That's about $4.8 billion for the March quarter. The projection was for 5.6, so it cleared the hurdle by a cool trillion won. And that's, by the way, that's also 4 times the company's earnings this time last year. So it's quite a turnaround so far as Samsung goes. And yeah, we are going into the Tokyo lunch break. We're better by about 1.5% on the Nikkei. And of course, we're still guessing what happened in the dollar yen market, but maybe you could fancy an educated guess what really did take place. A swing move down in 3 yen. There we go. Headed into the break in Tokyo, and we're in solid footing. 20 more ahead. This is Bloomberg.
11:29 a.m. in Tokyo. It is a busy Tuesday morning with Japanese traders heading back to their desks here after what was a collapse of dollar yen, right, of a 5-handle move. We're settling around that 156, 157 level once again, so still a little bit, reversing some of the losses that we saw, or the gains, I should say, overnight. But it's really helping the equity market in some ways. Take a look at that. We're up some 1.4%. Of course, we have to wait another month to hear whether they did, in fact, intervene or not into the currency data.
Yeah, don't take our word for it. They actually told us that. They released that data end of May, so that's going to give us confirmation. Maybe after the fact. Why not? Okay, Asia-wide, we're looking at, so fine, 1.5% in Japan. That's probably lifting the overall tide. 1% right now on the index. Every single sector, as you can see, is just about up on your screens. We're also getting a follow-through out of Hong Kong about an hour into the session here, so about 7 days of gains now. On the Hang Seng Index, we're on the precipice yet again, as they say there, of the bull market. 7 days of gains would be the longest win streak going back to Feb 17 of 2021, which, by the way, in case you didn't know, is Michael Jordan's birthday. Not that it's any relevance, of course.
How do you know that? Just the top of your head.
Feb 17, yeah. Well, he's the greatest of all time.
Okay, well, random facts that you have in your head right now. So here's some other facts we're looking at here today. Really was, of course, yesterday was the big announcement of this partnership between Baidu and Tesla. And we really saw those Tesla shares react on the back of this surprise trip from Elon Musk in China, which is reaping some benefits and dividends here right now, because given the fact that, it brings them one step closer to FSD coming to China. But as Stephen mentioned earlier, there's a lot of that going on already. In the mainland. A lot of competition in that space. We did speak to Dan Ives yesterday. He talked about it. Game changer. Listen.
It's a watershed moment. I mean, this is 3 years in the making that Tesla has been trying to get into China from an FSD perspective. And this unlocks a golden opportunity, not just for Tesla in China, but I think globally. And I think it's going to come as a surprise in a good way to investors. Long time in the making. It's a trophy case moment for Musk getting back on that plane, come back from Beijing.
Yeah, I think he sounded bullish there on Tesla. Of course, Dan Ives there, of course, has one of the highest price targets on the streets. Not the highest, but close to that on the share price on Tesla. Let's bring in our Bloomberg Intelligence Senior Analyst, Robert Lee, to talk us through this. Of course, this Baidu-Tesla partnership. Unlikely, he says, contrary to what we heard from Dan, to be a game changer. Tell us why, or why not.
Okay, my comments are referring more to Baidu. And let me give you a little example, analogy. Let's say you took a long Uber drive, a couple of hours. You went there, you got an itemized bill at the end. You'd be charged for the... I know this doesn't happen in reality, but just bear with me. Okay. You'd be charged for the driver's time. You might be charged for the fuel. Would you be charged for MacBook use? Would you expect to see that itemized? I mean, MacBooks are essential, aren't they? Because if you don't have a map, you don't know where you're going. So the equivalent with this is it's a much bigger deal to Tesla. It potentially opens up the China market to them in a more meaningful way in the long term. So definitely, a positive for them. Baidu is the MacBook provider. There are multiple MacBook providers in China. It's an incremental positive for them. It helps sentiment, but is it going to materially impact their earnings? No. And hence my slightly realistic, more cautious headline on the research that you've just mentioned.
Okay,
so I'm referring to Baidu, not Tesla.
Right, but we talk about that competition already in the mainland when it comes to autonomous driving. I mean, Steve was talking about Pony.ai. There's so many, basically almost every sort of car maker is exploring this idea. So there's still a lot of cutthroat.
If not doing it already.
Yeah.
That's right. I mean, EVs and obviously autonomous vehicles being where the industry may ultimately go this is China's moment, isn't it, with BYD and Li Auto. I mean, not only do they dominate the domestic market, but they're doing extremely well overseas, with, again, the full support of the state behind them. So in the same way that China dominates many other sectors within the tech industry, such as batteries, such as solar panels. Is EV going to be the next big thing? So the challenge for Tesla, even though it's got a fantastic track record, great products, you're going into an ultra-competitive market where you've got the full backing of the state behind these local players. So it's going to be, I think, reasonably tough for them.
Just to pivot to Samsung, they broke down their performance per business unit.
Yeah.
Anything stand out?
It's semiconductors, because the core of Samsung's business is relatively stable. So I'm referring to their TV, white goods business, the screens, all of that. That's sort of the cash cow business that underpins them, I should say. But the icing on the cake is these very volatile semiconductor businesses. So we've seen restocking demand come back on handsets and PCs. That's driving demand for NAND flash and DRAM products. With some incremental demand coming on the AI side, where they're trying to catch up with Hynix. So, yeah, it's a very cyclical business, and it all seems to be moving in the right direction at the moment. So, they beat consensus numbers, and the market has taken that well.
Yeah, Robert, thank you, Robert Lee. They're our senior analyst for Bloomberg Intelligence, joining us here when it comes to all things tech here today. We're also watching some of these banks in China, of course, like some ICBC, Ag Bank as well. I mean, rarer to see this, but their first decline in quarterly profit in more than a year, right? And it just goes to show the margin pressure that these banks are facing as they deal with a lot more push from the government and the like to really extend credit to developers, and of course the risk of what this means for loan growth overall. So you're seeing a mixed bag here. ICBC is actually up about 1.5% on the back of those results. Bank of China, though, is heading the opposite direction. We're down some 2%. That comes up next is really HSBC with their first quarter results. That's due in just under 2 hours or so, with analysts really focused on the outlook for the Chinese economy and the impact of potential rate cuts on the bank's performance. Let's get a preview now from our Bloomberg Asia finance reporter, Denise Wee. So, Denise, what are you expecting this time?
I think basically we're seeing net profits fall slightly. HSBC has been selling Western operations, pivoting money back to Asia. So we're going to see some one-time items. Basically, they sold the Canadian business, there'll be a gain from that. They sold the Argentinian business, there'll be a loss from that. So a little bit of one-time issues going on. The last quarter there was a BOCOM charge, which is, kind of a surprise investors on the downside. Right. So I think we're going to be watching for how things are going in China. Are things picking up? NPLs, is it bottoming out? Or are we seeing any improvement? That's basically what we're looking for.
What about the core business?
The core business, I think the wealth business is doing really well. In Hong Kong in particular, we're seeing lots of mainland money come to Hong Kong. I think opening up accounts, buying insurance, putting money into time deposits. Investment banking, however, has been difficult. There have been some cuts across Asia, more heavily focused on Greater China. We know the IPO market is really struggling. Yeah. And HSBC is all about Hong Kong at the moment, generally. Yeah. So it's tough, I would say, in the investment banking front.
Okay, we'll find out in 90 or so minutes from now. Denise Wee, our Asia finance reporter, on a preview on HSBC. Right, plenty more ahead here on shows. These markets are rallying across the region. There you go. This is Bloomberg. All right, welcome back to the China show. So 6 trading debuts specifically we're looking at right now. You have 3 spot Bitcoin and 3 spot Ether. And I think you're looking at these are the Bitcoin ETFs, of course, on your screens. Let's head back to the Hong Kong exchanges, where Annabelle is standing by, of course, with the next guest, and one of the other issuers, of course, of one of these 3, Bell.
Yeah, that's right. This is Harvest Global Investments, and I'm joined here this morning by Tongli Han. He's the CEO of this. And Tongli, I think we can kick off with the fee structure here, because your ETF has the cheapest out of the 3 that are being issued. Right. Free for the first 6 months, and then 0.3 after that. Yeah. How sustainable is that sort of fee structure, do you think?
Okay, so actually, to use an analogy, I think this ETF, the first ETF fund, okay, Bitcoin and the Ether funds, they are like the first bricks to build a house, okay? So we don't plan to make any money on the first bricks. We want to make money in the long term, be long-term greedy. We want to build up the entire ecosystem and to develop our business together with our partners.
Okay.
so that everybody will be winner going forward. And we will make a lot of money from the ecosystem. We build a house with the bricks, but not making money from the bricks, from selling the bricks.
So if you're not making money right now?
No, not yet.
Not
it's
yet.
It's hardly, break even so far.
Okay, but right now probably loss-making, and once the fee sort of kicks in after 6 months, then you'll be at a break-even point. Is that right?
Right. Yeah.
Okay, so where will you make money then from in the ecosystem? Where does that come from?
So it's like the collateralized financing. There's a huge demand from the crypto natives. Mm-hmm. Okay, they are Bitcoin-based investors. They don't want to lose their Bitcoin. Okay, so that they can exchange their Bitcoin into our ETFs and use our ETF as a collateral to get financed for their daily operations.
Right.
Okay, so this is only one example. And going forward, we are going to also launch the other, more sophisticated ETF products like the reverse ETF, the multiplier ETF.
Yeah.
And also perhaps, we are going to issue some covered bond or the ABS based on our ETF product. So there's a lot of very exciting things to do because this year I think it is like a singularity point for the cryptocurrencies because they get compliant in this year. So the two parallel universe begin to cross over to each other.
In-kind redemption is what really makes a difference from the cash only.
Right.
In-kind redemption then, based on the fact that you're saying that you could see a lot of need for collateralized loans using this spot Bitcoin and spot Ether ETF, what's the sort of demand that you're expecting for that in particular?
I think the demand is huge. I think,
could you put
maybe
a dollar?
More than 20% of the existing Bitcoins are used for the collateral financing in the crypto world right now. But going forward, more and more those kind of business will switch over into the traditional financial market.
Mm-hmm. Okay, so going back to making cash then, actually making money and turning a profit from this, where do you see yourself being able to clip the ticket?
Right.
Where will you make money, do you think, from the ecosystem?
Everywhere, I think. The ecosystem, as long as the ecosystem is there, so many new business will be derived from that ecosystem. Mm-hmm. And we want to make money from our visions, but not, but not from the zero-sum game. We make money because somebody lose the fees to us. We don't want to do that. We want to grow our business to make profit together with our investors and also together with our strategic partners.
I'm curious. There were some issuers we might have expected to see coming to market today, and CSOP is one that comes to mind given they already have the futures ETS of Bitcoin and Ether. They aren't bringing a spot product into the market, and one of the concerns perhaps is that the ecosystem for digital assets in Hong Kong is not mature enough just yet. What do you think is missing?
Yeah, of course, the ecosystem, the building of the ecosystem, we just lay the first and second bricks into the ground, okay? So it's just we just started. Mm-hmm. It's not there yet. It's not there yet neither for the U.S. market. So we are on the same starting line. So we are representing Hong Kong to compete with the U.S. as the cryptocurrency financial center going forward.
Do you see Hong Kong being competitive then against the US? Because right now we've got maybe 53 billion in AUM in the ETFs in the US, and Hong Kong, our Bloomberg intelligence team is saying it could be something like 1 billion within 2 years. What's the addressable market, do you think?
Yeah, Hong Kong is part of the global markets. It's not a local market, actually. Okay, so the system, the software system in Hong Kong is Anglo-Saxon system. However, the location of Hong Kong is within China, within Asia. So that makes Hong Kong has a very special position as one of the most prominent financial hubs in the world. And secondly, it's a SAR region of the second largest economy. Okay, so both Western investors embrace Hong Kong's financial market, and the Oriental countries, the Eastern countries, also accept Hong Kong as one of the most attractive financial centers. And also with the design of our product, we are attracting money from both the traditional financial world and also the crypto financial world.
Do you see any path to investment from mainland China directly?
Not yet.
Okay.
Not yet. So I think China and the U.S. are taking the different strategies to develop the blockchain industry. So right now, China is still closed, but Hong Kong is kind of like a sandbox to make Hong Kong to do the experiment. So over time, the potential is much bigger in Hong Kong.
Yeah, because what makes also the issuers today quite interesting
Right.
is that all have Chinese origins or a large presence in China as well. So what would be the most straightforward path? Would it be, for instance, these ETFs being included in the ETF Connect program? What would be the next point, do you think, for access for mainland China?
That will depend on the regulation conditions. And I think the regulators are watching closely how those, Bitcoin cryptocurrency ETFs develop in Hong Kong. They want to contain the risk. As long as they feel comfortable with the risks, I think the market will open gradually.
You mentioned earlier, I said we'd come back to it, about the different products that you're working on and levered, inverse. What's the next product that you're going to be bringing to market, do you think?
The next product, I think, going to be the multiplier.
Multiplier,
ETF.
in what time frame, do you think?
By the end of this year.
Wow.
That's our
okay.
target. Yeah.
All right, very ambitious. All right. Tongli Han, thanks very much for your time. That was
Thank
the
you,
CEO
Annabelle.
there of Harvest Global Investments, Dave Yvonne.
All right, Tongli Han, our thanks and hello to, of course, the CEO. It's been a while since he's been on our program, of course. You can get an insider's guide to the money and the people shaking out the finance hub in our new Hong Kong edition newsletter that's out every Thursday. You can sign up through the website, bloomberg.com/newsletters. And here's your China Brief this morning. A look at what's making headlines in national newspapers. And most media are actually focused on President Xi Jinping's upcoming trip to Europe that's been confirmed. France, Hungary, and Serbia is on that list. And Xinhua rolling out a microsite even dedicated to his visit and touting China-Europe ties. His trip, as we talked about, starting on May 5th, will be Xi's first visit to the EU in about 5 years. And Xinhua says his visit will inject, quote, new impetus into world peace and development. The Global Times also saying that Xi's trip shows China and Europe are exploring the prospects of cooperation in an era that has seen strategic competition intensify. That seems to be a veiled reference to the U.S. and its attempts to limit China's access to advanced technology. The report does note that this is the first overseas tour that Xi will make this year and underlines the importance Beijing attaches to Europe.
Yeah, and of course, the visit comes as China-Europe tensions bound over issues such as trade and this war, of course, in Ukraine. Let's bring in Rebecca Chun-Wilkins, our Asia government and economy correspondent, with us here on set. It's the first trip, I believe, since pre-pandemic, since 2019. Let's talk about the overall objective of the trip. Closer ties, so it goes without saying. Just contextualize that for us.
Yeah, I mean, I think really big picture, this is about putting space between the European Union and the US. So in the last year or so, we've seen this real momentum growing that is moving the EU position closer to the US, particularly when it comes to looking at this series of mounting probes. So after that, France backed that probe into EVs. We've had them on all sorts of areas of other sort of new energy, green tech-related areas, on solar panels and so on. And we've even had, even before those results come in from those investigations, we've had Chinese firms pulling out of certain tender offers and certain bids and so on. So in some ways, the sort of big mission here is pretty clear. It's about convincing the European Union and convincing European powers that there are more benefits to doing business with China and keeping those trade lines open with China than moving closer to that US position. Now, if we look a little bit more detail in the kind of sort of itinerary of the trip, quite carefully constructed there, France, Serbia, Hungary, all nations where I think President Xi Jinping feels like he may have a warmer reception. Certainly Serbia, Hungary, those are two obvious, closer partnerships there. But with France too, Macron has in the past seemed to offer a more independent position and this sort of friendly personal touch, some great details emerging there about what Macron has planned for this trip.
I mean, just the menu, right? They're talking about they're going to serve French cognac, which is a liquor subject to Beijing anti-dumping probe. So It's interesting, right? But what sort of charm offensive are we likely to see, really?
Yes,
from the French and from the Chinese, really?
Yeah, this is really interesting. So what we've had is this very personalised trip from Emmanuel Macron. We know he kind of likes to have this approach to diplomatic sort of encounters, but he is taking President Xi Jinping to his grandmother's house, nestled in the Pyrenees Mountains, where he spent a lot of his childhood. Sources telling us it's somewhere that's very, very important to Macron. Wow. And this is about sort of a reciprocal move, because if you remember when Macron visited Beijing, President Xi Jinping brought him to the Guangdong governor's residence, which is where his father was held a post, and they shared tea with Macron. So from Macron's point of view, this is about, again, building those very, very personal ties, and it speaks to this idea, right? Why is it that President Xi Jinping thinks that going to France is so promising, thinks that this may be a way for him to build a better ally within the European Union, who is able to perhaps even advocate to slow down on some of these probes, having previously actually been a main backer of them?
Yeah, the French foot forward, as they say. So you talked a little bit about Serbia and Hungary already. Just elaborate more on that as well.
Yeah.
What could they achieve in those two places?
Two really interesting countries, because both countries, one that stand obviously closer to Russia, so some important signalling there, tend to have sort of sided against or had this distrust in NATO, for example, and US-led institutions, but also both been very open to Chinese investment. So on the Hungary side, we have this potential for Chinese investment in railway infrastructure. That could be a sort of showcase for the EU about the type of investment. Hungary is the only European country still that is a part of the BRI since Italy pulled out. So worth remembering, Hungary is sort of an important ally there. Also has the potential to sort of be obstructive when it comes to EU policy on China. Serbia important because she may be landing and arriving on the 25th anniversary of the Belgrade bombing, which is such a foundational moment of nationalist narratives in China. It's a very evocative moment that, you know, helped to see distrust of the US and see distrust of NATO. So some important signaling going on there too when it comes to China's position on Europe. Quite layered, quite nuanced.
Yep. CATL also planning to maybe build a plant in Hungary, too, with that partnership with Mercedes. All right, Rebecca Wilkins, thank you so much for previewing that trip for us here and the charm offensive we're going to see in France. Market check here right now, L'Occitane. Speaking of French.
Speaking of, okay.
Retail, luxury, creams and hairsprays, hair products and the like. We're not checking that. We're checking property first. You take a look at this right now. You are seeing a bit of a reversal from yesterday. I mean, yesterday it was like sizable double-digit gains in some of these property stocks. You're on the prospect of maybe we'll get some more stimulus here in the real estate sector, this sort of build versus buy versus build, program that market chatter is talking about here today. L'Occitane, that's the one confirming that buyout. We're seeing shares up close to 10%. This is Bloomberg.